welcome to this presentation today. Myself, Charlie Burton, in association with OGM. They have put their usual risk warnings. Will I send us the link for the registered session later tomorrow? I don't know, David. I'm literally like, I'm a passenger here. I've just logged in and to deliver this. It's not, the software is their software, so you would have to ask OGM. So as usual, they put a risk disclaimer. When I looked at the slides, when they put their stuff on my slides, I quite like this, that they've put on, the vast majority of retail accounts lose money when trading. And I mean, most brokers, they'll put 77% or 82%, of traders lose money. They have to state the specific number of accounts, if they're in the UK at least anyway, that are losing money at any one time. And it's quite funny, really, because most retail accounts actually have more winning trades than they have losing trades, and yet they lose money. Personally, I have more losing trades than I have winning trades, and yet I overall am profitable. And so maybe that's where a lot of retail traders go wrong, who are in this, vast majority here who do lose, because they're chasing high win rate returns or high win rate strategies, and it's probably not the best way to go. So it's natural to want to go down that path, because it sits well with us. We want to, as human beings, we want to be right as much as we can be, but it's not necessarily the best thing to do. But anyway, we'll discuss that as we go into this. Now, they've asked me if I would look at the markets first of all. So we'll have a quick look at the markets. And no, I've got a presentation to deliver to you. And this presentation I actually delivered back in October, I think it was. I've added a couple of extra slides to it. So there's quite a lot to go through in that presentation anyway. Because I'm a true believer of that mindset is so much the key. And I know you hear this all the time, but I've learned the hard way myself over the last 25 years of trading. And that mindset is by far the most important thing, not the latest strategy or whatever. So you can have a great strategy and still lose money, in my view, because as soon as a great strategy has a few losers, then people start to do all sorts of things and second guess when the next winner might come and all that sort of stuff. Start banking profits too soon. So mindset comes into a huge portion of trading. And so my view is that people should spend much more time on their mindset than on trying to find the perfect strategy. The Holy Grail is certainly not a strategy. The Holy Grail is you and your approach and mindset. So let's go and have a look at the markets here. So I've got a chart up here of the S&P 500, and so it's a popular one that people look at. And so I thought we might as well start with this one. I think one of the first points to mention with the S&P here, I've got a few moving averages on here. My gold colored moving average, yellow gold, is the 200-day moving average. I've got this on a daily chart at the moment. And the S&P is comfortably above that 200-day moving average. If I zoom out, it spent the whole of last year, or most of last year, breaking down below it and being capped by it last year. So it's the first time that we've spent above that 200-day moving average. So I think that's an important thing to note. The other one is this trend line here. This trend line is a very obvious trend line. Most traders around the world have had this trend. Sorry, are you saying you can't see? Can you see my chart? I just want to double check. Oh, you can. Right. Okay, that's all right then. Good. Okay, people can see. I saw someone said. Yeah, anyway. So yeah, so this trend line. Your video is black. You may need to log out and log back in again, Daniel, because if other people can see it and you can't, then usually it's just something at your end. So you may just have to log out and log back in. Yeah. So so this trend line's been quite an obvious trend line here from the highs of early last year. And so we finally got that break. I'll take us back into the daily chart in a minute. But I think this was a significant break, obviously, thus far. When we actually came up here, which I'll break it back into the daily chart now, this point here, where we had this whopper of a move. I think this was on FOMC in December, and then it ended up becoming a false breakout of the trend line. That was key, because at this point we'd already tried to come up to the trend line before, then we had a false breakout and then came back off. If the market was going to carry on selling off, this was the point that it was potentially going to do it, and it didn't. Obviously, we chopped sideways. Well, it's still a consolidation, could have still broken to the downside. It didn't. This up day here I thought was interesting, because it was the first strong up day after a period of 2 weeks of consolidation. And so I'm starting to look at this chart at this point that price will probably want to come, say probably, we trade in probabilities, not certainties, probably want to work its way back for the trend line. And so and if it gets up to the trend line this time, then it should break out. So it got to the trend line, had a reaction again, but then ultimately broke out. So where I'm at right now, as far as the stock market is concerned, if we look at the S&P, it's right against some key resistance at the moment. Again, if I take us out to a weekly time frame, you can really see this resistance line that I've got on my chart here, which is at about 41.40 or so. The amount of times that it's been tested all through this price action here, going way back, it's a really nice level. So it's one to watch here. I'm sure many of you have got a level very similar to that on your charts if you're looking at the S&P. So if I take this back to the daily chart, then what we're looking for is a breakout now of this line, because to see if it can, because we've broken out of the trend line, which is a positive, and now we're at this horizontal resistance point here, or zone, should I say, around the 41.40 area. I'm not looking at the absolute highs here, because this stems way back. So some form of strong up bar pushing through there would probably be enough. So I think that's something to look for. We're seeing other markets heading to new highs. If we look at the likes of the FTSE, heading to new highs, having underperformed for years, really. If I go to the monthly chart since 2017-18, when the US markets have been powering ahead, the London market's just underperformed. And yet this year we're seeing the London market really outperform, and the German DAX is performing well as well. Now, some of that comes down to asset reallocation globally amongst fund managers, with the UK market and Europe having cheaper valuations relative to the US at the moment. So, but nevertheless, that outperformance that they're going through, I'd still like to think that at some point the S&P, even though it could still pull back a bit again yet, there's nothing to say that it couldn't pull back here some more yet. but I think it's something to look out for, this this level here. And if it can break through that, then 4,300 is the next target, which would be up here. Okay, so if we get enough time at the end, I'm more than happy to look at some other markets, but I just saw it in the presentation blurb here that I was going to look at some charts here. I think what's interesting post CPI, yesterday's inflation report, which did come out hotter, today's retail sales came out really strong as well after abysmal retail sales for December. Part of that was weather related. Is that you know, on the back of, you know, two fairly strong reports, you might have thought that the stock market would be pulling well, in my view, pulling back some more at the moment. It's a bit soft today, but it's not massively down. The currencies, the dollar is very strong today, but the stock market's sort of just holding its ground at the moment. So that's, I think that's still a positive there, because it's interesting. We're in an environment at the moment whereby good news is bad news and bad news is good news, you know. So strong retail sales could lead to, you know, more inflation, and therefore the Fed maintaining their hawkish stance and possibly hiking rates even further than expected. And the stock market doesn't tend to like that. So I still think the stock market is trying to discount the future, but maybe there's a bit of a repricing going on. We're certainly seeing that in some areas. Okay, I have to be careful because I'll carry on talking about the markets the whole time otherwise. So what we'll do is we'll go through this presentation here. During this presentation, I'm going to be talking about mindset. I'm giving you some of my tips that I share with my traders in relation to mindset. I'm also going to show an entry technique that I've been using for several years now, but I'm going to it particularly performed well last year, and just, well, as it was in line with what I was doing in my analysis. But I thought I'd share it, and then you can take it away and see if you can apply it into your analysis. Okay. To start off with, I thought I'd share a couple of charts here. This, you can take a screenshot of this if you want to. This is the S&P 500 average weekly performance from 1900 to present. So each bar is each week of the year. So I don't know what week we're in right now. So we're in probably week 6. So it gives us the average weekly performance, and so gives you a general guide. For some reason, look at the average weekly performance of week 20. I don't know why it's such a drastically underperforming week, but that's probably May. So yeah, and October is off. September and October often have weaker performance as well. So I thought I'd share that with you, just because it might be something you might want to take a screenshot and just have a sticker there, so it gives you a general guide as to the probabilities of up weeks and down weeks. Now this chart is I've put 2 charts up here, one for the bulls, one for the bears. Really, this one's one for the bears. This is operating margins, and we've seen this decline in operating margins in S&P 500 stocks. And so, you know, is this still a sign that, you know, there's more downside to come? Possibly. But then I can also look at another piece of information here, which shows major S&P 500 lows since 1932. And we can see that October has by far the most lows that have been put in. Now, if I go back to my chart of the S&P, funnily enough, the low that was placed in October of last year so far is the low. And so I think it's worthwhile just pointing that out for the bulls there. Again, by all means, take a screenshot of this, but I think it's been said that you'll be able to get access to these slides anyway. Now, this final screenshot is one that I've been using a bit. There was a few at the time, and this was again in, I think probably late September, maybe early October, that this, oh yeah, there it was, October the 2nd here. Might as well look at the date on it, might I? So this came out on October the 2nd. The headline of Bloomberg Business Week was "Can't stop, won't stop. The Fed has turned the US dollar into a wrecking ball, and there's no end in sight to the carnage." And if I come back to the charts here and look at the dollar, that article came out on the 2nd of October, about here, somewhere over here. Anyway, so it came out somewhere over here. The dollar never made any new highs, and obviously has then subsequently gone lower. Yes, it's having a turn up again right now, but in relative terms, the dollar had been having a tremendous year last year, and it so often is the case that journalists have this impeccable timing that as the fever accumulates, the sentiment towards certain markets, that journalists are going to, they experience that as well, and they're going to write about what has been happening. And they're not traders, they're just journalists or analysts, and they can't help but a lot of the time get that timing wrong. And so that was a classic there when looking at the dollar index, that pretty much they nailed it and nailed the top, and yet they was trying to say that the dollar was going to continue appreciating, you know, and it was a wrecking ball. So when we do get sustained moves in markets, and then you do see, you know, high profile magazines, financial publications coming out with articles like this, you've always got to start looking the other way and look for reasons why, you know, we might be close to a bottom, because it's not an absolute, you know, from a timing perspective, it's not going to be absolute, but it starts to give you the idea that, you know, we may be there or thereabouts. Now, the euro dollar at that point had bottomed just a few days before that. The euro dollar bottomed on September 28th. So if I bring up the euro dollar here, so I was looking for reasons to be a buyer of the euro dollar. I'm not just going to buy just because, you know, a few financial publications have put that article, those sort of articles out there, but I then combine that sentiment, that general sentiment, which was very bearish towards the euro dollar and bullish towards the dollar, and then start looking for signs of reversal. And this day here, I did get long. It was a bullish engulfing. I'd love to tell you that I got in here and I rode it all the way up. That didn't happen on this occasion, and so it had a nice run. Oh no, that article wasn't out at that point. No, the article wasn't even out at that point. But I did, you know, this was a genuine reversal. I think it was on something like CPI or something like that. And what I think was interesting with this one was that it was a piece of news which should have been bullish for the dollar, but the dollar retraced up backwards, and that's always a good sign. So did trade that the following day, but ultimately just got trailing stopped out when it did a deeper retrace here. Did get in later through this move, but I'll discuss that with you in a bit. Okay, so let's talk about mindset for a little bit here. Many of you will have seen this before. It always amuses me. what people think trading success looks like versus what it really looks like for a lot of people. And unfortunately, we're in this new era of social media, and in trading, there's always been, the snake oil salesman out there trying to tell you that they've got some keys to the Ferrari, of how to make you a better trader or whatever. The reality, in my view, is that trading requires blood, sweat, and tears, and you need to roll up your sleeves. And there's no easy fix, magic solution, and then you're just going to be sitting there on the beach, or driving your Ferrari down wherever. So it's not really quite like that. So, and the market's constantly trying to challenge you as well. So, when you see these kids on social media, you do think, don't believe any of it, because it's just nonsense. So the reality of trading success is it's a bit more squiggly than that. And the reality is that you have to have a long-term view. It's not a get-rich-quick scheme. And if you can have a long-term view, like taking up any other profession, then you're in a much better position than if you think you're going to be a master trader in the space of 3 or 6 months. In any other profession, it can take years to get good at it. Why should it be any different with trading? Okay, so trading is counterintuitive. It is what we've been taught, what we've learnt in our lives, actually a lot of the time doesn't work in trading. So, for example, those fight or flight responses that we naturally have as human beings actually are counterintuitive. They don't actually work for us a lot of the time in trading, because when we're trying to run away from something in trading, our natural fear comes in. We don't want to take a trade. Sometimes they're the best trades we ever take. I'm sure many of you have taken trades or not taken a trade through fear and thought, oh no, I don't like this. Even though it's a valid setup, you're just not comfortable taking it. And yet, after the fact, you realize that trade would have worked out. So that's a key example there of just how our natural responses don't actually help us. So we have to learn to embrace all of that. And when we want to run away from a situation, we have to look the other way, and see all the reasons why maybe we should actually be taking that trade. Oh, didn't mean to do that. Right, okay. So we'll go through these. You're here to make money, not feel good. I use this line a lot. Lots of traders, the amount of times I get people sending me messages on my YouTube channel or on social media saying, oh, I made XYZ, I had a great trade on this or whatever. And that's lovely, but we're not here to feel good. If you want to feel good, I always say go and have a massage, because if you go down that route of trying to make yourself feel good, then you're putting yourself at risk of doing all of the things that you shouldn't be doing, such as banking profits too soon. That's a classic of a trader justifying, that at least they've had a winner. Oh well, at least I've made a profit. And you hear that old expression, you can't go broke banking a profit. Well, you can, because if you start banking your profits too soon, they're not going to pay for your losers. So we have to keep reminding ourselves of that one, because it's not about us, how we feel. And it's horrible at times in trading when you're sitting there with a big open profit. I very regularly get into trades where it might be up 10, 20, 30, 40,000 pounds in open profits and see them come all the way back down to zero. And you have to let that go if you're going to stay with your plan. you're here to make money, as I've said here, not to feel good. If I was here to feel good, I'd be banking the money. But you've got to stay true to your plans. And whereas a lot of traders go wrong is that they don't, and they can't help themselves. And they say, well, last time it rolled over against me and I was in some nice open profits. I'm not going to let that happen next time. Then the next time they do that and they bank their profits early, and they would have made so much more. So it's that sort of stuff. Traders react emotionally to their last few trades, whatever's gone on in the past or in the recent past. They're always looking to try and fix. Sometimes there's not actually anything to fix. They just got to carry on doing the same sort of things if they've got a good process. Trust in it. I've also put down here, you can't win until you learn how to lose. I think it's an important aspect of trading, is learning how to lose, accepting that you are going to be wrong, let's say 50% of the time. And I'm being kind here. Yes, people have higher win rates than that, but let's just go with 50%. My win rate's less than 50%. So think about it in this way. Think about it that, before you even get out of bed to trade, accept that you are going to be losing 50% of the time. Now, for me and for some of my traders, it's more like 60 to 70% of the time that we're looking to lose. So maybe we're a bit more battle hardened because we're so used to losing, but when we do have the winners are so much bigger. But even if you have, a 50% win rate, a 55% win rate, whatever it might be, you still got to embrace it and accept losing. It's just part of it. We can't possibly be right 100% of the time, and we don't need to be in order to be making money from the markets. Now, when I was a young boy, I was about 12, I took up the game of snooker, and I got pretty good at it. I played for my club as a sort of a 13, 14-year-old. And I saw this quote from Steve Davis, the 6-time world champion back in the 1980s. And he said, winning or losing, that's the byproduct of everything else. You've got to love the game and enjoy the competition. And that's exactly the mindset to have with trading. It's not about winning or losing. That's the byproduct. You've got to enjoy the game. And this is what I say to people. You've got to love trading. If you're only in trading for the money, then sorry, I can see there's lots of questions coming through. I will answer questions towards at the end. So I will answer questions at the end. So if you're only in everyone gets into trading to make money, of course, but you've got to have a passion for trading, because trading, the markets are going to challenge you time and time again. Just when you think you've mastered the markets, they're going to slap you back down. Just when you think you've just had a great winning streak, then you'll go for a drawdown, or you're in a great trade and it rolls back over against you, or all these things that happen. So you're constantly getting rejected from the market. So you have to love it. You have to have a passion for it. If there is no passion for it and it's purely about just making money, then you'll become one of those 80% of people that quit. And so we don't want that. We want more people who don't quit trading. The problem is the 80% who quit have never properly educated themselves, especially on the mindset, to really understand what they're doing. And so, of course, they very quickly give up once they realize they're not making any money, and which is of course a shame, because for most traders, they don't become massively successful in their first 6 months or a year. Okay. And we will be influenced by our basic instincts of greed and fear, of course. Okay, so I'm gonna have to speed up this presentation. So let's go through the 5 stages of the trader mind. We've got the excitement about trading with no plan. So this is a beginner sort of getting into trading, excited about it all, but no real plan. Then they go through that deep disappointment, maybe 6 months in. Like, what's the old quote? Like 90% of traders quit within 90 days of opening an account. And they either quit or they carry on at this stage. So lots of people do have a disappointment. Some people think, no, I want to push through. I'm not going to be a quitter. But then the others do. Now, some traders go down this route and think that strategies are the answer. We are pummeled on social media and the likes with strategies, people selling strategies or talking about strategies. And of course, we have to have strategies, but they are not the answer. They are just part of the process of profitable trading. But the problem is, if you go down that rabbit hole, then you start chasing strategies. You find a strategy, you start trading with it. It stops working after a while. You move to another strategy, and so on and so forth. And I come across people who have been trading 5, 6, 7 years who have been doing exactly that, because they've gone down that wrong path of searching for strategies. Without realizing that it might be other aspects of their trading and their mindset, which are what are the reasons for them not being profitable. Oh yeah, so there we go. And then hopefully some people transcend, they go through all of that and they realize that mindset is the missing piece of the jigsaw. For some traders, this can take a few years. For others, it may never happen, and they carry on chasing strategies and still thinking that that's their solution, but overall don't actually make any money. They make money for a while, they make some really good gains sometimes with some new strategies, and then the strategies fade away and they give it back, and then they move on a year later to the next one. But if only they look back over their history and realize that it's not actually making them money. So they continue to, they're lying to themselves, really. Anyway, so what are we going to do? Study the various problems that traders have: banking profits too soon, over leverage, over trading, moving stops too soon, and show you some solutions to these problems with some guidance. And what I personally do in any of these situations. We need to have a skin like a rhino. Robert Kiyosaki, the author of Rich Dad Poor Dad, I quite like this quote. I stumbled across this one when I was putting these slides together last year. Winners are not afraid of losing, but losers are. Failure is just part of the process of success. People who avoid failure also avoid success. I think that top 2 lines are the most important here. Winners are not afraid of losing, and that's where we need to be with trading. We have to embrace having losing trades, dust ourselves down, move on to the next trade. Because if we carry on trying to look for ways of being right more often, then you're just a marketeer's dream. Okay, so fear-based problems. Remember that the market will do its best to create bad habits in traders. So the market will, like I said earlier on, it will slap you down at times, and then what happens is you've been in a trade, like let's say my example earlier on, you've been to nice open profits and prices come down and you've got stopped out. What happens is people then start looking for reasons why they should never allow that to happen. Right, I'm going to trail my stops a lot more aggressively. Well, if you trail your stops a lot more aggressively, then you're almost guaranteeing you're never going to have a big trade, because the majority of trades, won't. They'll always pull back at some point anyway, and so you'll just get trading stopped out. So that'd be a classic example of creating a bad habit, or the fact that people will just say, oh well, I'll bank my profits soon, I'm not going to let that happen to me again. Or people want to move their stops to break even really quickly as well, and so again, that's a bad habit. Many strategies and entry techniques are actually perform better if you never actually move the stops up. So banking profits too soon. This is such a fear-based problem. Of course, the fear of a profit turning into a loss for a fear-based trader is big. So, and for a lot of traders out there, in my dealings with brokers, there's two things that brokers say, generally speaking, about their client bank. If they look at the masses on the like we've got down here. If we look at the masses, the large majority who lose money, they bank their profits too soon, and they run their losers. So what they mean by running their losers is that they either have very wide stop losses relative to banking their profits, so they have inverted risk reward, or a lot of them don't use stops at all, and so because they fear actually recognizing a loss. So that can happen as well. So it is a problem. Moving stocks to break even, as I've already said, is a big one as well. Again, very natural to want to do that. You get people say, well, it's a risk-free trade now. Is it really? I would beg to differ on that one. If you move your stop to break even, here's your break even level here. And then price pops back down, and your original stop loss was down here. Price pops down, and then off it goes again. Well, I would argue, is that really, like I was saying, a risk-free trade? Because you've now interfered with the trade, and you've now missed out on what would have otherwise been a profitable trade. So it's actually adding to your overall trading risk, because you've missed out on what would have otherwise been a winning trade. So you have to be really careful of that. Some strategies and entry techniques do have points where you can certainly move your stops up, but be very careful of moving them too aggressively. Closing out before a stop is hit to save a few pips or points. Yeah, you do hear this as well. I've come across many traders do this over the years. They think they're going to get stopped out and then interfere and try and help them cut their position early to try and save a few points, only for then the market to turn all the way back up again. So these are all the sort of things that happen. As soon as the trade is on, seeing all the reasons why it'll fail. Now this one is obviously a lack of confidence. So if you get into trades and then once you put them on, seeing all the reasons why it will fail, it suggests that you shouldn't have taken the trade in the first place. You shouldn't really feel like that. If you've done enough analysis, you should have the confidence to take the trade and then stay with the trade. Of course, there's still going to be, with every trade we take, a given percentage that aren't going to work, but we shouldn't allow that to particularly affect us. Panicking when a trade starts to pulling back, having been up previously, as I've already covered this one off, and not wanting to take the next setup having been stopped out. So again, another classic fear-based trader problem is they then start hesitating because they've had prior losses. Okay, greed-based traders love to be right, which can also be fear-based as well. So they have a desire to be right. Not banking profit at a target, so they don't actually, they get greedy. When they've got to their targets, they think, oh, maybe I can make more. So again, they basically don't stick to their plans. Greed-based traders are much more likely to not use stops because they want to be right. They don't want to admit being wrong. Betting too big relative to the account, so using too much leverage, over trading, revenge trading, all of these are greed-based issues in the main, adding to losing trades, so putting more positions on. There's nothing wrong with being in a trade which is underwater that you've pre-planned to add to if it comes down, because you've pre-planned it out, you've risk managed it out, you've put a smaller position in initially, and you say, right, okay, there's two levels that I'm interested in buying at, here and let's say here, and you put a half position in here and you put another half in here. That's just good management. That's not what we're talking about though here. You get people, greed-based traders, just adding to losses to try and bring their average price down, because a lot of the time they're not using stop losses. They trade too loose, no discipline, as I've said. They don't really trade with a proper plan, and they often think that they're better than the market. And I can speak with from personal experience with this, because when I started trading 20 odd years ago, that's what I thought. I think a lot of people think that, oh, this is easy enough. I should be able to learn this. I should be able to, be better than the market. So I was that greed-based trader. They're much more likely to get overconfident. They're much more likely to be laying in bed thinking about the money, but they also become bored quickly, have a lack of patience, struggle to stick to that plan, and have a get rich quick attitude. That's a big danger zone there, because they need action. Now, does anyone here not know who this chap is? Does anyone not know who this chap is? Okay, Anthony. This chap is no, this is Paul Tudor Jones, and so Paul Tudor Jones is like a legendary fund manager, and he's still about to this day. And he started trading in the 1970s. I would recommend, if you don't know who he is, to pick up Market Wizards, the book written by Jack Schwager. It was written in 1988 or 9, I think it was, and it's still as relevant today as it was back then. He was one of the traders who featured in this. And in that book, that's Market Wizards by Jack Schwager. And I read his story. It was a collection of interviews with some of the most successful traders of that era, of the 1980s and 70s. And he was one of the people that I really, when I started trading and I read that book, that I really admired. I admired a lot of them, but I guess I just quite liked his style, so to speak, and from reading about him. But as you can see up here, he's got a little note on his wall there: losers average losers. So what I just said about those greed-based traders adding to losers, if one of the world's greatest traders says that, you should really take note. Okay, let's go. Yeah, I know there's loads of questions coming through, and I will come back to your questions. I'll just completely lose it otherwise. I don't even know, how am I doing for time? Probably not too well. Right. Focus on the process of trading first of all. So forget thinking about the money. The money will take care of itself. You have to focus on the process of trading. Try and be the best trader you can be, rather than thinking about how much money you can make. There's an old expression that says retail traders think about how much money they can make. Professional traders think about how much money they can lose. And what that's really talking about is that professionals are much more likely to be looking at their risk management and following their processes. They're not thinking about how much money they can make. They're just looking at their risk management. The money will take care of itself. Retail traders, the less successful ones, are always thinking about the money. So one of the best things I can give you is to say, focus on the process. Be the best trader that you can be, the best at executing your methods, the best at analyzing, the best at logging your trades, and reviewing your trade journal, all of the processes of trading. That's what you need to focus on. The money will end up taking care of itself if you focus on being the best trader that you can be, and that's by focusing on the processes. My advice, don't use targets. I hear people all the time saying, how much money can I make, Charlie? How much can I make a month? Can I make per year? The problem is if you have targets and you say, right, I want to make X percent per month or X percent per year, is that, especially with monthly targets, that you're more likely to, let's say you had a target of, I'll just make up a figure, let's say 5% in a month. And you, you make 1% in a month. Well, how are you going to feel then? You've underperformed your target. You're more likely to then start trading more aggressively next month to try and make back that money or the lost percentages or whatever. So again, your focus is on the end goal, not on the process of being a good trader. Trading returns, like that squiggly diagram at the beginning of tonight's presentation, are erratic, and so some months, some years are going to be massively different to others. If you're a day trader, it's the same. Some days are going to be great, and then other days will be not great at all. And so if you hold yourself to targets, then that's going to influence you and influence your decision making. So you're better off to not have those and just focus on executing the best you can. Don't trade tired, angry, or intoxicated. View trading as a long-term venture, not get rich quick, as I've already said earlier. When the market runs away from you and you think that everybody else is in that move, one, they probably aren't, but two, don't worry about it. There's always going to be another trade. And if it was something that you were looking to get in on, but for some reason you've missed, give yourself a slap on the back, give yourself a pat on the back, actually, and say, well, at least my analysis was right. One thing that we need to do is to constantly be turning a negative situation into a positive, and I'll talk about that in a minute. So don't think everyone else is in the move. They're not. Normally, when you see a big move in the markets, it's usually the few bigger players who are driving that move than all the retailers. As I've said, put a positive spin on any situation. So if you've analyzed the market but it's run away without you, then say, well, at least my analysis was correct. So be pleased about that. Likewise, if you get stopped out, price goes up a bit, pulls back, stops you out, and then carries on going higher, and your stop loss was here, and you've been nicked out of a position, it happens, only for price to go higher. Now, you could get really frustrated, and an average retail trader is going to get really frustrated with something like that. Whereas really turn it into a positive and say, well, at least my analysis was correct. It didn't work out on this situation, but there'll be plenty of other times when it will. And so again, keep turning negatives into positives, because negative emotions breed more negative emotions, which affect our ability to trade as well as we can. So really try and put a positive spin on any given situation that you can usually find in the market. When reviewing performance, don't simply look at the bottom line. Again, look for the positives that we can take, because sometimes there can be trades that you may have shouldn't have even taken. When you actually review, if you keep a trading journal, then you can see that there's trades that you shouldn't have even taken, and say, well, actually, what was my performance if I hadn't have taken those trades? And that helps to reinforce, a bit like having a mentor saying, why did you take that trade? It's like your own personal mentor. And also there will be trades that nearly got to target, but maybe just got nicked before they got to the target, or like the one I've just gone through, or they nearly got to target and rolled over. So again, we can take positives from that, and we can say, well, actually, if I just looked at my my P&L for this period, whatever that period is, whether it's a day, week, month, and it might be minus. But actually, there's some positives to take from some of the trades. I always say that trading is fine lines. It's fine lines between success and failure. And what I mean on any individual trade, sometimes you just get stopped. Sometimes trades just don't get to your target. And you don't think that there always has to be a solution. Sometimes there is. Sometimes it might be that someone is doing something genuinely wrong, but a lot of the time it's not. And you just have to say, okay, fair enough. Didn't work out this time. We'll move on to the next trade. This trade is just one in the next 1,000 trades that I'm going to be taking. So why am I worried about it? Ah, there we go. Just saying that. Think about the bigger sample size of trades, not the outcome of this trade. Put this trade into context. This is just one trade out of the next 1,000 trades I'm going to be taking. Don't track your account balance each day. Again, why should you not be checking your account balance each day or week? If you're doing that, what are you doing? You're looking at the end result again. You're looking at the money. You're not focusing on the trading. So you've got to be very careful how often you're looking at your account balance, because then you become drawn into what that's doing and trying to get that ticking up, rather than thinking about and concentrating on being the best trader that you can be. You become the best trader you can be, that account balance will take care of itself. If you're staring at the account balance, your focus is in the wrong direction. How can you also be focused on the others? Manage expectations in relation to the current trades. Always think about how much you have at risk rather than how much you can make, as I've already said there. Desensitize the trade as well, like I've just said. Now, this trade is just one trade in the next 1,000 I'm going to take. Try to desensitize it so that its outcome has less importance. Don't allow yourself to get excited about the winners. That's a beginner's mindset, and yet I see people with 5 years experience plus still getting excited about winning trades. If you get excited about winning trades, what do you think is going to happen when you have losing trades? You're much more likely to get depressed or frustrated or whatever. You're experiencing emotions. We want to have an emotional plane which is stunted like this. That's our emotional plane. We don't want an emotional plane like this, getting excited on the winners up here and then getting depressed down here, because again, that makes trading stressful for starters, and trading shouldn't be stressful. Trading shouldn't be stressful. If you're trading with correct risk management and the right mental approach, then there's no reason why trading should be stressful. And so don't allow yourself to get excited about winners. That's not the game. The game is, for every new winner you have, you don't know when the next losers are going to be coming along. So just accept it for what it is and move on. Moving stop losses to break even is just there to make you feel good, as I've already said. A lot of the time people say that. I've already covered that off. And don't be a busy fool. The mascot on a teddy bear approach. People, when they're trading at home, don't have they don't have a mentor sat next to them. And a psychologist I was working with many years ago with some of my traders gave us this idea of traders talking to a mascot or a teddy bear. So talk out loud, and then what happens is it fires a different neural networks in your brain when you talk out loud versus when you're just internalizing a thought. So if you're about to do something, have a mascot or a teddy bear or sat on your desk, something, talk out loud. And sometimes just by doing that, the answer comes back to you to say, no, you probably shouldn't be taking this trade. If I was sat next to you, or any experienced trader was sat next to you, again, you can use this as a technique as well. Would you still be taking this trade, or moving the stop loss, or banking the profit? One other trick with banking profits too soon is you have to ask yourself, can I afford to bank this profit? You know, yes, it's going to make me feel good right now, but I can't afford to bank this profit, because if I come out too early and it carries on going higher, then I've missed out on that extra profit, and that extra profit is what gets, which is what pays for the losers and makes that overall profitability. So it's a good line. I cannot afford to bank. Okay, some actionables here. Write down key messages. I've gone through loads of them now in this presentation here. Write a pre-trade checklist of your mental actions, talk out loud, and do some visualizing of the execution and the management of the trades, not visualizing profits. That's what children do. Visualize the execution and you managing your trades well. And I'd also say within visualization, if I go back to that I visualize all scenarios. I don't just visualize when I look at the charts or the market going up to my targets or whatever. I visualize all outcomes. Maybe it goes up, maybe it goes up in a straight line, maybe it chops around, then goes up, pulls back and goes higher again. All of the different things that can happen, I will basically visualize, so that I'm sort of mentally prepared for anything that goes on, whether it gets to the target or it just ends up rolling over. And then repeat everything. Repetition is key in trading. So, and for me, repeat, if I do a piece of analysis on a market, like I just went earlier, did a bit of analysis on the S&P, I won't just do that once. I go back over that chart over and over and over again, looking at it at different angles, different time frames, because that's what helps you to stay in the trades when you get there. Okay, at this stage, I'm just going to take some of these questions. I know we're overrunning here because we're already on 6 o'clock. So let's, I'm just going to see if I can answer some of these questions before I go to this last bit. Um, 40k profit is insufficient for you. Monroe, if you're still there, it's all relative. I give these examples out because I like to shock people, because I know that to a lot of traders, they'll be thinking, oh God, I would have wanted to bank that. But it's all relative to the size of your account, isn't it? So, but it's still a lot of money. You know, even though I'm trading with sizable funds, £40,000 is still £40,000, but I can't afford to bank that on my larger accounts. If that's not my analysis, you've got to trade your analysis. So if I bank a profit at 40k, I'm never going to make 150k, am I? Ever. So that's what I was trying to say there. How old am I? I'm 50 and feeling about 60 today because I'm really unwell. If more than half of your trades fail and you do not exit them early, as your advice, your losses grow. No, it's about risk to reward that. So if you have a 30% win rate, so you're losing 70% of the time, but you have a 30% win rate, and then for every winning trade, though, let's say you make a 1 to 5 risk to reward, yeah, on the winning trades you have, you're going to be profitable, nicely profitable. So let's go through a scenario. So 30% win rate. So with a 1 to 5 risk reward. So out of 10 trades, so you're going to have 7 losses. So There's your 7 losses, I think. Yeah, okay. So we've got -7 because you're risking 1 R. So that's 1. So for each one of those, that adds up to 7. And on your 3 winners, you've made 5. So you've made +15 on your winners, giving you a net outcome of what? +8. So it's a simple scenario showing you how you can have a 30% success rate and still be comfortably profitable. So in fact, most of the many of the traditional fund trader managers actually have lower win rates. So because they're looking for much bigger risk rewards. If anyone's ever read the Turtle Traders books, and some of those original Turtle Traders are still about, one such turtle, a guy called Jerry Parker, ended up starting up Chesapeake Capital, ended up becoming a billionaire, and yet he said that he would be right about 40% of the time, wrong 60% of the time, but of the ones he was right on, only about 10% were actually the big wins. The rest were just marginal gains, just being stopped out on a trailing stop or whatever. So it was actually 10% of his entire trades that were responsible for his gains. And yet one of the most prolific, successful fund managers that's out there. So yeah, it's just changing your view of what's what you do in the real world versus what you do in trading. You don't need to be right all of the time. And the reason I'm saying that is if you go down that route and you try and be right 80% of the time, you will be one of those people that quit trading, because that is where that's the path to ultimately losing, because you get so focused on being right all of the time that the stress and the fear once whatever your approach stops working, then you end up just a lot of people end up quitting or having to have a realization that, oh yeah, that was the wrong path. It's better to have a mediocre win rate and look for better risk rewards. Which one he wrote to? Monroe. Market Wizards, he's written way more than 2 books, but it's the original one I think I was talking about back there. What attracted me to Jones's style, I quite liked his aggressiveness, actually. Why not re-enter after a stop out? Yeah, you can do. Yeah, absolutely. Yeah, if your analysis is right and you get trailing and you get stopped out, trailing stopped or whatever, you just get nicked out, then absolutely you can. I will do that. Yeah. Once it's turned back around, then I'll yeah, I will do that. What do you do when a stock reaches resistance? That's too generalistic a question. It's without looking at charts. Every single chart, every single scenario is different, so I can't answer that. What other books and authors do I recommend? I was quoting some of my traders just yesterday, Michael Covell's book, which was on the Turtle Traders, actually, which was the complete Turtle Trader. That's well worth reading because the true story of the Turtle Traders. So that's well worth picking up. I love Market Wizards. I do think it's a cliche because we all recommend it, but I met Mark Douglas 20 years ago. He's passed away now, but I think Trading in the Zone by Mark Douglas is good, but here's a bit of a left field book. And there's no books I'm going to recommend to you on how to trade, because that's all, no, forget that. Probably the Bible of technical analysis, yes. If you want a technical analysis book, then yes, by all means. But a book was a little bit different. It was a book called The Hour Between Dog and Wolf, and that's by Coates. And he was an ex-Goldman Sachs banker, I think it was, but he also had a PhD in biology. And in that book, they did a lot of studies, and they were looking at how our biology can affect our trading decisions, and things like testosterone levels, elevated testosterone, and lowered testosterone as well. So that was a really fascinating book. And so, yeah, hard going at times, but worthwhile reading through. I'm trying to scroll through these because I'm already over here and I haven't quite finished this yet. I'm in profit and it reaches the key resistance. Is it better idea to book a profit or wait for it to go to next level? Most of the times in this market, after touching the resistance, the stock fails and comes back to support. Yeah, well, one thing you can do, Vishnu, is bank a partial profit. So do consider, banking half. When it gets to resistance, banking a partial profit, and then at least you've banked half, but you're still giving it the room. If it does break through, you're still in with the other half. So banking partial profits is something you can do. Obviously, I don't know your approach, and but there are going to be those times when it does break through. So it does come back down to your analysis. So for me, if I've got a higher target, then I'll just hold for that higher target and put up with these resistance points along the way. And sometimes the resistance point might turn that price all the way back over against me, but I'll just see that as just part and parcel of what I do. And I don't really care about that because I'm only interested in those fewer trades that are going to go all the way. They'll work out for me. I don't need to have lots of them. Matten, it's a membership that I have. By all means, go and check it out. Most of my members are on the gold membership. It's just go to Charlie Burton Trading and you can have a look at all of that. Okay, right, we've caught up with the questions now. So if people are still wanting to go for another, I'm going to go through this very quickly in 5 minutes. So we'll just go for it for 5 minutes and then we'll call it a wrap because I know I've gone over. And what you can do is you'll get the recording of this anyway, so then you can go back over it. So I'm going to go through it fast, and but you can all obviously watch the playback. So this is something I've been looking at, this is something that I was trading a lot with last year. Just so happened to be the market environment that I was trading, and I was trading the euro dollar a lot. I trade the euro dollar a lot. And so the first thing to note is this is used in conjunction with larger directional or trend bias. So you have to have a view on the market first of all. It's not a platform, it's a community matter. I'll do it in a minute though, but it's a trading community. So I have a trading room and I'm in that trading room every day. I can't email you. I don't have your email. I'm an independent coming in to do this presentation tonight. So I'll type it into the box in a minute. So you still have to have done your analysis first. You've got to have looked at the market, looked at all your support, resistance, your trend lines, channels, whatever you're looking at. on a market, and then you've taken a view on a market that you generally want to be long or you generally want to be short. So then this is just purely an entry technique on the back of the analysis you've already done. So on a daily chart, you can use this on any time frame, intraday, whatever. But anyway, we've got a 5 simple moving average, an 8 simple moving average, and then we've got 2 5 exponential moving averages. One of them is set to the high, the other one is set to the low. So that's 2 5 exponential moving averages. Now, normally by default, when you put a moving average onto a chart, it's by default set to the close. But if you've got a bar, so I'll just put a price bar on here. Normally the closing price is what the moving average will be set to, but you can opt to set the moving average to the low of the day or the average of the highs. So that's what we're talking about here. 2 5 EMAs, one set to the high, one set to the low, and then an MACD 12, 26, and 9. Okay, that will get you a chart looking like this. The black envelope, if you will, are those 2 5 EMAs. The one is set to a high, one is set to the low, and then the red and the orange are just the standard 5 and the 8 simple moving averages on there. So what I'm generally looking for is I had an overall directional bias for the euro last year, which was negative, which was to the downside. So when we would go through sideways or upwards corrections, once we started rolling over again, I'd look for the 5 and the 8 moving average to be in the position of crossing, and then a breakdown bar, ideally, well, for closing below the lower 5 EMA, but also if there is some prior lows there, then ideally then it's closing below those as well. So this was a day that I got short with my traders, and we had a decent run on that one. We actually had a short on this day here. This was the day that actually Russia invaded Ukraine, actually. But and so these are just some of the main trades that I had last year, the winning trades that I had last year. So I had this one here, I didn't put it onto the chart. So I had one there in the main. There's some smaller ones, but this was it. So what's that? 1, 2, 3, 4, 5. That takes me into October. I'm trying to remember now. There would have been another one on the short side and then one on the long side at the end, I think. So it's about 6 trades. It was about 6 or 7 trades. Now it was 6 main profitable trades in the whole year. That's all I needed. And on that account, I made 134%, I think it was. The rest of the time, I'm either losing or roughly scratching a trade. Small losses and then big wins when they come through. So same again over here. Price is broken down here, broken below the lower 5 EMA, below this congestion point here. So that's the entry there. Same over here. Price is then broken down here below all of this. And so a nice little run down there. Not a huge run because you're getting in a bit late there at that point, but don't always get in necessarily right at the highs on the retracements. So this is an entry technique. If you've missed the retracement and you've not traded the retracement and just waiting for a bit more confirmation of it rolling over, you can still use techniques like this to get you in. So another big down bar here. Actually on this one, I was already in with half a position from after this. This was a big inflation day data. And then we added to it on this day. And every time we have with these arrows, we're looking for the MACD histogram to have gone negative as well, to have gone negative on each one of those. 134, what do you mean by net? It's 134%. Yeah, net after charges. Yeah, that is the net. Yeah, after charges. Matt, and I'm not going to email you directly. I'm sorry. I'm not. After losses. Yes, net. That is the net. That's the gain for the year. Let me just put that into the box here. Oh, maybe there you go. I think Mayton, I've put that up now. I've posted that web address. Okay, now interestingly, the euro. Oh yes, that's right. So the euro bottomed in late September, and then we started coming up. And what was interesting is that we started looking on the long side in early November. Well, I was already looking on the long side before that. As I said at the beginning of the presentation, I'd got trading stopped out here. And anyway, we ended up getting in over here using that same technique again. Candle closing on the outside of the band. It's going to come up in a minute. MACD histogram up. Click on that. There we go. Then we've got that break above these prior highs. And then if I click forwards, we can see that it started carrying on going higher, did a pullback for a while, and then eventually, oh, okay, this is the higher time frame. This is some of the other analysis that it had come down to a key level of 96, which dates back to this 2001 high. So we knew it had come down to there. As I said earlier in the presentation about all that bullishness towards the dollar was a warning flag that maybe the sentiment had got to an extreme. So we were looking for excuses to get long. Anyway, and then that's where the euro had its run. Well, most of you will know where the euro is now, but it's been up to what, just over 110 into the early part of this year. So we didn't, you know, that trade, we didn't run all of that way, ran up into, fun enough, into the 105s, but we were in down here, somewhere down here, down in the 101s. It was a really nice, it was actually, this trade was my biggest trade of the, oh no, we'd actually, take it back, we'd actually already got in down here, not on that setup, but on another setup on this, I think this was non-farm payrolls day. And then we were adding along the way as well. So we quite often add to a trade as it goes into our favor. That trade, that long trade, was by far my biggest trade of the year, as it turned out. So anyway, I said I'll go through it quickly on this last, yeah, these are swing trades, yeah. What's the level of risk reward? Yeah, oh, I wish, every trade I take, Norbert, is going to have a different risk reward based on the targets that I have for it. So if we take this as an example, you know, I'd got in, we'd got in somewhere at 98.50, I think, somewhere halfway up this candle, somewhere like that on this particular day. So we use intraday to get in on some trades, and then exited at 105.40. Now, with the benefit of hindsight, I should have stayed in it, shouldn't I? But you know, you have to take your levels. I had a load of resistance zones up here that I was comfortable coming out of. So every trade that I have is going to have a different risk reward based on the analysis. I don't, you know, I think I don't trade with a mechanical risk reward really and just say, right, I'm just going to target 1 to 3, because, well, the market might not be giving you 1 to 3. You know, you've got to trade what the market's, where the resistance is and where the analysis is. So every trade is a little bit different in that regard. So, but some trades, certainly I have the ability to make 20 times my, you know, my average loss. And I've had a couple like that last year. So yeah, gives you an idea. And some of my traders, one of my traders just recently did a 1 to 47. risk to reward ratio on a dollar yen. So yeah, but it comes down to analysis. The entry techniques are just the entry techniques, but combined with the overall analysis, your directional analysis, then you always make sure you pick out where your targets are before you get into a trade. You don't get into a trade and then decide where to come out. That's ridiculous, because you're never going to have too much bias once you're in the position. You need to have already assessed before you take a trade what the potential risk to reward is for that trade, where you're targeting, roughly speaking, and whether it's a good deal, so to speak. Do I do pound dollar? Yeah, I mean, I do trade other markets, other markets as well. Of course, yeah, I trade all the major currencies at times during the year. The euro dollar is my favorite. It's the biggest currency pair. But I do trade other currencies at times as well. I traded the pound fairly recently, actually. I also trade the stock markets. So I trade a number of markets, but certainly over the last couple of years or so, the euro probably accounts for like 80% of what I do. But it doesn't matter. It's just my personal take. Now, I've taken up way too much time, and I'm sorry if I'm a bit stunted here tonight. I'm amazed I've managed to get through without being sick, basically. So thank you ever so much for your questions here tonight. And hopefully some of the things that I've gone through this evening are of some use. And yeah, maybe I'll see some of you soon. Take care for now.